The broadcast is now starting. All attendees are in listen-only mode.
Hey, good morning, everybody. It's Thursday, September 15th, 2022. Hope everyone is doing well. It's been an interesting week so far in the markets. And, it's always fascinating because, the markets is really a collection of, people's thoughts and, I want to say predictions, but they're what they're expecting the market to do, and up until a couple of days ago, everyone thought we were going to start rallying again, but obviously the inflation numbers came out and the market sold off. And again, today, the market again is still feeling that selling pressure. And what I'm going to talk about today is how to discover new trading strategies with order flow. And, we all know that, in trading, we always want to have an edge. Okay. And fortunately for us, we live in an information age, and there's just a lot of information out there that can help a trader. And honestly, it is overwhelming trying to sift through it all and figure out what's relevant to you and your trading style. And that's why I'm glad you took the time to join me today for this quick training session. Now, what you're going to learn today is you're going to learn about order flow and how it affects the market. You're going to learn how to leverage that order flow data to uncover hidden trading opportunities. And I'm going to show you how to profit from understanding how orders move market prices. Now, for those of you that are new to one of my presentations, my name is Michael Valtos, and I've got over 25 years of professional trading experience. I started on the Chicago Mercantile Exchange trading floor as a runner. I started literally at the bottom of the industry, and I worked my way up over the years. I left the floor when electronic trading started taking off. I was working for Dean Witter at the time, and they needed, what was called the Globex operator. That was what the overnight session was called. And, I said, hey, you know what? I was in my 20s at the time, and, I interested in computers, and it was computerized trading. That was the beginning. So I took the opportunity to leave the trading floor and work up on their off the floor trading desk. And unfortunately, at that time, there was no such thing as side by side trading. So to trade those markets, you had to work the night shift. And I ended up working the night shift for, almost 10 years. And, I enjoyed it, actually. You don't have to deal with the office politics. After about 3 years with Dean Witter, I left to join EDF Man, the big English trading company in Chicago, on their global macro futures trading desk. After that, I joined Commerce Bank, also in Chicago. I became the licensed Eurex trader there. I was only at that time back in the 90s. I was only one of about 10 people outside of Germany that was allowed to trade German bonds, DAX, Euro stocks, etc., on the exchange provided trading system. After September 11th, I took about 6 months off, traveled the world, trying to get my priorities straight. Then I joined Cargill in Chicago. Cargill's a big commodity trading firm. It's a privately held company, but if it was a publicly held company, it would probably be the first or second largest company in the United States. They provide about 25% of meat exports, about 35% of grain exports. I ran their trading desk in Chicago, and when the exchange in Singapore closed down, they sent me out to Singapore to set up an off the floor trading desk. In about 2005, 2006, I left Cargill and I joined JP Morgan. I was vice president of futures trading in Singapore. I spent 8 years there, 8 or 9 years. And after I got married, had my first kid, I decided, you know what, there's more to life than working 12 hours a day at JP Morgan, coming in and just spending more time in the office than at home. And I left to trade for myself. And eventually I started up in 2015, orderflows.com, which is an order flow education company and a trading software. And I've been doing that since 2015, and it's going on 7, 8 years already. So the reason I talk about my background is because I've traded at a very high level, and I understand how order flow works, right? Because I was a lot of that order flow, right? I was a size trader, and I saw what my orders can do to the market, the effects that it has on other traders that are out there, just trying to survive, trade for their own retail accounts. And I saw how my big orders could come in and influence the market. And now what I've done is I've taken a lot of that information that I've gained over the years, and I've tried to put it into software for retail traders. Now I'm a retail trader. I don't consider myself a professional trader because I just trade for my own account. And sort of, I want to level that playing field. I want to make it easier for smaller traders to understand what's really happening in the market by having software that is going to help debunk what they're looking at in the market. Now, the charts and the tools that I use in this training are generated from my order flow software. But honestly, what I'm showing you today can be applied with other order flow footprint software as long as you know what to look for. There's my software which runs on NinjaTrader 8. There's Sierra charts. There's Motivate. There's a lot of software out there. Okay, but to be honest, unless you know what to look for and more importantly know how to use the software that you have, it's kind of pointless to trade with order flow. So that's why I enjoy doing these trainings, is so you can learn what to look for, because I get emails all the time from people saying, even people that don't use my software, say, Mike, thanks for making this video or doing this training because now I understand what's happening in the market. And really, you want to be able to see how easily and quickly you can apply order flow analysis to your trading to make better trades. So before we jump in, brief disclaimer, trading does involve risks, right? The risk capital is money that could be lost without jeopardizing your financial security or lifestyle, and only trade with risk capital you can afford to lose. So when it comes to trading, every little edge is going to make a big difference. That's why I'm always on the lookout for new ways to get an edge on the competition. And one tool that I found very useful is order flow trading, right? And this goes back to my days on the floor. When there was a trading floor, you could see what the order flow is coming in. Once it went electronic, it was anonymous, right? You can't see who the big buyer is or who the big seller is. You could see the trades taking place, and then you got to start, reverse engineering and put it together what's really happening in the market. But once you understand order flow, you're able to make better informed trading decisions. So remember, order flow is all about understanding how orders are being traded, right? By tracking these trades, you get a feel for the market sentiment and you're going to make better trading decisions. Now, order flow is not easy. Trading is not easy, but order flow is a tool that's going to give you an advantage in the market, right? And you want to have an edge over everybody else. Now, the first thing I'll talk about is order flow and how it affects the market. Okay, so now order flow is simply a way to organize the trades that happen in the market. Now, every trade that happens shows up in the time and sales. This is what the time and sales on most trading platforms look like, right? You see the time, you see the trade that went through, you see the quantity, right? Now you'll notice there's different colors, right? Because some trades are happening on the bid, some trades are happening on the offer, right? A market's always trade in a two-way auction. There's always a bid, there's always an offer. So there are traders bidding and there's traders offering. There's people sitting on a bid, whether it's, if it's 5 bid at 6, there's bidders sitting at 5. They're happy to buy at 5. They don't want to go chase the market. They don't want to pay 6. They think the market is worth 5. Then you have sellers offering at 6. Those are the offers. Those are passive sellers. They are, in their mind, they think the market is worth 6. So they don't want to sell it at 5. They want to sell it at 6. Okay. Now, bids and offers by themselves don't cause a market to move, right? You need some trading that's going to take place. And there needs to be aggressive traders who cross that bid offer to get a trade done. Traders who buy the offer or sell into the bid, those are called aggressive traders. And think of it like this. Recently I had to buy a car, okay, another car. And, there's a car that I liked. I went to the dealer. The car is listed at, the price 35,000. Okay. Well, that's what the dealer would love to sell it at. He's a passive seller at 35,000. Now, maybe I don't want to pay 35,000. I want to pay 30,000. So my bid is 30,000. The dealer's offer is 35,000. So I'm a passive buyer at 30. He's a passive seller at 35. I be upfront. I like this car, but all I want to spend is 30,000. So for me to buy the car, the dealer would have to get aggressive, lower his price, sell it to me at 30,000. Now, if it was a situation where it's like, oh, I really need this car because I got no transportation, and the dealer says, oh, the price is 35,000, I'm firm. Okay, well, for me to get the car, I got to pay 35,000. I'd have to be the aggressive participant in that case. So, think of it that way, right? There's always a bid, there's always an offer. The person that crosses the bid offer is the aggressor. Okay. Now, by tracking the order flow, a trader is able to see which way the market is moving because you'll be watching which way the aggressive trading is taking place. And that's what you want to look for, right? Is you want to look for the direction the aggressive traders are trading. Now, again, it's a two-way auction and there's always aggressive buying and aggressive selling. Really what you're looking for is the more aggressive buying than aggressive selling. That's what's going to cause the market to move up or down. It's not that, for every buyer there's a seller. What you're trying to look for is the aggressive buyers outnumbering the aggressive sellers. So on a dome, right, this is your depth of market, your price ladder. Passive sellers are people working the offers at the offer price and above. Passive buyers are people that work the bid price and below. Passive traders are willing to wait for the market to come to them, right? They're happy, if the market's trading 39.53 and a half, they think it's worth 52 and a half. They're happy to throw in a bid here, wait for the market to come to them, right? They don't want to pay 54. They don't want to pay 55. They want to pay 52 and a half. They're passive. They're waiting for the market to come to them. If the market starts moving down, then, aggressive traders are selling the bids, taking it out, turning it, offers are coming in, hitting the next bid, before finally that passive buyer gets filled because the aggressive sellers have taken over and cleared out all the passive bids there as the market moves down. The aggressive traders cross the bid offer line. They hit the bid or lift the offer. Now, what the order flow chart does is it takes all that information that's happening in the time and sales, right? All this information right in here that you see the green numbers, the quantities, the red, orange prices and quantities, and it puts it into a nice, easy to read format. So you can see how much volume traded on the offer at a price, how much volume traded on the bid at a price. So when you format the data into an order flow footprint chart, you can see not only the volume traded in the two-way auction, but you can determine the aggression that's taking place or not taking place, right? Because just because, we talk about aggression doesn't mean there's always aggressive trading in the market. A lot of times the market is just doing what it's doing. It's just facilitating trade. Now, most traders, we start at a normal candlestick chart, but candlestick charts tend to be misleading because, people will like to say, well, because it's green and red, oh yeah, I could see order flow. Well, no, all you're really looking at is the open, the high, the low, the close. I mean, they have what they call wicks, which is these little parts above or below a candle, which is the difference between the high and the open, or the low in the open, or the low in the close. And if everyone thinks, oh, I'm looking at order flow, you're not. You're just looking at price. Really, that's all you're doing because you don't have volume. You don't have whether the transactions are taking place on the bid or on the offer. So what you're doing with order flow, again, you're taking all this information that comes through on the time and sales, price, obviously time, the volume, and more importantly, whether it's trading on the bid or the offer. And again, on a candlestick chart, where is that information? It's not there. It just doesn't exist. So from the time and sales, once you put it into a footprint, you're going to get a lot more information that you can analyze. You're going to get delta, right? Delta is the difference between aggressive buyers and aggressive sellers in a bar. You have max delta, which is the strongest aggressive buyers were in a bar. You have min delta, which is the strongest aggressive sellers were in a bar. Cumulative delta, which is the net delta, which is a measurement of aggressive buying or aggressive selling for the day because it's cumulative. So you're starting it from a point. You have point of control, right, which is the price level in a bar with the most volume, and you have imbalances, right, which is telling you, when aggressive trading is out of balance, right? So when you have more aggressive buying than aggressive selling by a certain percentage, which I'm going to talk about later, that's what you would call a buying imbalance. If you have more aggressive selling than aggressive buying by a certain percentage, you'd call that a selling imbalance. Now, the best part of order flow is you're using data generated from the trading that's taking place in the market right now. It's not based off of, a 200 period moving average where you're going back 200 periods for it. you're making trading decisions based off of what is happening right now. So what you want to do is you want to use this information because it adds value to your trading. So what do you think is going to be more useful? Just knowing the open, the high, low, and the close of a bar, or knowing where and when aggressive trading is taking place? So on a footprint chart, it's very basic stuff, right? You're going to learn. You're going to look at it at the end of the day and say, you know what, that's not that complicated. So here's S&Ps, right? We're selling off, then we rally, a nice V shape. And it's simple, right? Market is going down, lower, lower, lower. It's got negative deltas, right? Aggressive sellers are in control. Then the market starts rallying, positive delta, right? Boom, boom, boom. You even have blue numbers in the bar, which is our imbalances. Buying imbalances on the way up, selling imbalances on the way down. Point of controls, right? The price level in the bar with the most volume are going lower as the market's going lower. They're going higher as the markets go up, right? Volume, right? This is, Granville 101. Markets move on heavier volume, right? They move directionally, they go up. A sign of a nice trend up is higher prices on higher volume. And if the volume is migrating higher in each bar, in each period, whether it's a 1 minute bar or a 5,000 volume bar or a 30-minute bar, you want to see the volume in the bar transacting at higher prices. So the easiest way to determine the aggressiveness in the market is to look at delta. Okay, and this is yesterday, right? We're at the high of the day up here, 39.81 and a quarter. And what do you see, right? Looking at the delta, we're at the high of the day. I'm seeing negative delta, right? We're coming up into the high, even got negative delta. So it's telling me that there's aggressive sellers up here at the high of the day. Now, what do you think that information is telling you? Well, it's telling you to get short, right? Because it's telling you that at the high right now, when we're trading up here, right, as this bar is forming, you see the delta forming in real time. You see the negative delta. Even the next bar, more negative delta, right? So you're like, okay, we're at the high. Are we going to go higher or are we going to reverse? Well, if you see a lot of selling coming in, aggressive selling coming in at the high of the day, chances are it's going to reverse. Just as when we're at the low yesterday, we hit 39.29, and then the market rallied up off that, rallied 20 points. But what was happening at the low of the day? Positive delta, aggressive buying started appearing. Okay, you're at your low of the day. You just sold off from 39.81 down to 39.29. What is that? 50 points. And then you're seeing nice aggressive buying coming in, positive delta, positive delta, positive delta, right at the low of the day. Market's screaming to you that this is your buying opportunity. Okay, so again, sometimes it's just so obvious, right? This is earlier in the week in the S&Ps. Okay, we could put this little bit of a rally in. It's from 41.24 all the way up to 41.33. Then we just go sideways. As we're going sideways, what's happening? You have negative delta all coming in here. You got 1 bar, 2 bars, 3 bars, 4 bars, 5 bars, 6 bars before the market drops back down into the 24s. And this is something that's important, is this market is going up, right? You got the aggressive buying. Now it's just going sideways. Okay, 1, it's not going up anymore. And 2, you have aggressive selling. Okay, so 1, if it's not going up anymore and it's going sideways, and 2, you're seeing aggressive selling coming in, what's the third option? The market's going to go down because the market, 1, is not going up anymore. 2, as it's just sort of paused here, you have aggressive selling coming in. That just leaves option 3 because 1, it's not going up. 2, it's just going sideways. 3, you got aggressive selling. Finally, you put enough stuff on the cart, it's going to fall over. And it does, right? It falls right back a quick, 6, 7 points in a few bars. This is also S&Ps. S&Ps, a wild week so far in S&Ps. Today's no different. This was on the 12th. I think the 12th was Monday, right? We're going up, making new highs, negative delta. All right, got a new high by 2 ticks, right? Go sideways, new high by 2 ticks, negative delta, negative delta, negative delta. Even in here, negative delta. You hit the high, you sort of come off, go sideways, more selling, right? So imagine you're going up to the high, and all of a sudden, what do you see? You're seeing aggressive sellers coming out of the woodworks. Well, if that's not a sign to you that you should be getting short, I don't know. I don't know if you should be trading, because the market is just telling you you got to get short, right? The trade is to the downside, not to the upside. Now, if it was going sideways like this and all of a sudden you started seeing some nice positive deltas coming in, yeah, chances are we would go higher. But instead, you're seeing negative deltas coming in. You're seeing the aggressive selling coming in. So chances are for the move to go down. So that's how you can use aggressive traders to determine, market direction. Now, put the odds in your favor, right? That's the famous line from what was it? Mockingjay or whatever. May the odds forever be in your favor. And in trading, it's the same way. You want to leverage the order flow data to find those trading opportunities that nobody else sees. And again, we're always looking for edges in the markets. And there's many different ways to get an edge in trading. One way is to recognize changes in the order flow. When there's a shift in the order flow, it can signal a change in conditions that can be exploited, for profit, basically. I don't like to use the term profit because, I don't want people thinking, oh, this is the holy grail. No, I mean, there's still work you still got to think about what you're doing and your trading. But, order flow shows you shifts in market sentiment so you can take advantage of them. Because at the end of the day, order flow is what creates price movement. Markets go from balance to imbalance, back to balance. And it's when markets are out of balance that trading opportunities happen. Okay, so remember, I told you market generated information that comes from order flows: delta, max delta, min delta, point of control, imbalances, value areas. But what I'm going to talk about now is imbalances. Okay, so an imbalance occurs when in the two-way auction you have more aggressive buying than aggressive selling by a certain ratio. So a buying imbalance would be when you have 4 times as many aggressive buyers than aggressive sellers, meaning in the two-way auction, if the market is 5 bid at 6, 100 trades on the offer at 6, but only 20 trade on the bid at 5. So, 20 into 100, right? It's a difference of 5 to 1. So you have an imbalance there. That would be considered a buying imbalance. A selling imbalance would be, the opposite. If you had 100 traded on the bid, but only 20 traded on the offer, that would be considered a selling imbalance. And when they come in and where they come in are important to us as traders. So you can see here, right? Market sold off, then the market shot right back up. As it's shooting back up, all the blue numbers inside of the bar are buying imbalances. Red numbers are selling imbalances. The black volumes is just your normal order flow, right? There's nothing out of balance there. But when you're starting to see big areas of imbalances come in, that's a sign to you that, what? Trading activity has picked up. There's an aggressive trader in the market. You probably want to be not fighting that big aggressive trader, right? You probably, at a minimum, want to be going with him. And you'll notice as well, some bars have stacked imbalances. This is a stacked imbalance here. They got a little stacked imbalance here. But other bars also have buying imbalances, but sometimes they're spread out. Now, stacked imbalances are easy to see in a bar because they're nice and neat grouped together. They're a nice little cluster, so to speak. But bars that have multiple imbalances that are spread out, it's a little bit harder to see. And if you have trading software, it can highlight that to you. So you can see in this red bar here, there's 1, 2, 3, 4 selling imbalances. Now it's not stacked, they're not stacked neatly on top of each other, they're spread out in the bar. So you know that there's aggressive selling, but it's a little spread out in the bar, but it's still aggressive selling. It's still information that you want to use in your trading. Market sells off again, another bar with aggressive selling spread out in the bar. They're not stacked. This is a stacked buying imbalance in here. This one in here is a stacked buying imbalance. But here you got, one price with an imbalance, then a regular order flow, another imbalance, another regular price with regular order flow, another imbalance, a little bit lower and towards the bottom, another selling imbalance. So they're not stacked neatly on each other. And to be honest, if you're just looking at a normal chart like this, you might not notice it because the markets are trading, a lot of stuff's happening very fast. You might miss it. But if you had software, right, that will just highlight it to you, say, hey, you know what? You got multiple imbalances in this bar. Then you just take a second look, say, oh yeah, I got multiple selling imbalances. Market hits the low, bounces back up. Now you got a stacked buying imbalance in here. Obviously, this bar's got multiple imbalances because of that stacked buying imbalance. But then the next bar, right? You might miss that if you're not paying attention, right? But you've got 3 buying imbalances in there. They're spread out, but nevertheless, they're in that bar for you to see, to take advantage of, right? Because everyone is so focused on stacked imbalances, but they're not necessarily paying attention to multiple imbalances. And that's what I'm talking about, having an edge in the market. Multiple imbalances in a bar is just as important as stacked imbalances in a bar. Okay, here's another one. Market more or less going sideways, in here. And then, multiple selling imbalances followed by multiple buying imbalances. Markets go up. Markets start going sideways. Multiple imbalances, multiple imbalances. Now this first one's got a stacked selling imbalance. Then this one's got more selling imbalances, but this time it's spread out. So you got 2 bars together with a lot of selling imbalances. Which way do you think the market's going? Do you think it's still going up? No, chances are it's going to sell off, and it drops nicely. Over the next 3 minutes, it drops 10 points. Right, it even goes down, another 10 points from there as well in the next 5 minutes. Now here's gold. Okay, so gold, is going up, and then you get a bar, some nice buying imbalances. Okay, but it doesn't go any higher. Right, it starts turning in here. As it turns to start going lower, multiple selling imbalances in this bar. Multiple selling imbalances in this bar. Right, market sells off, goes sideways a little bit, and then multiple selling imbalances, and market continues lower. This was just this morning at 8:15 this morning in the gold. There's gold as well, right? Coming into the low, okay, multiple selling imbalances. That's what you expect to see going into lows. Then market starts ticking up, multiple buying imbalances, multiple buying imbalances. Now, this is where it gets interesting because if you're just looking for stacked imbalances, that's nice. You can do that. But you're going to miss trades like this, right? This one came before the bar with the stacked buying imbalances. So imagine, where would you rather be buying it? In here, off this bar, like buying it somewhere in here, or way up here, $1.50 higher. Well, you want to buy it as low as possible if you have a reason. And you do by looking at the bars with the multiple buying imbalances. This is 10 years, right? 10 years, very liquid market. Right? A lot of volume goes through in the 10 years. This is at 2 in the morning yesterday, right? Off the low of the day. This red line is the low. You got 1, 2, 3 buying imbalances. Now 10 years, this is a 4-range chart. Okay, so you're not going to get a whole lot of stacked imbalances, right? It's a 4-range chart, so it only covers 5 prices. But imagine 3 out of the 5 prices are buying imbalances. What do you think that market is telling to you? It's screaming buy. And the market puts in a nice little rally up. This is 10 years again. This is today. This is this morning. And this is why, I talk about having software that's going to help you with your analysis, is because you might miss this, right? You might miss it as it's happening in real time. You're seeing some bars with some buying imbalances, selling imbalances, but this bar right here in the middle, it's got 1, 2, 3 buying imbalances, right? It's not hard to miss if you know what to look for, but if you got software that's going to help you highlight those, that's just worth the price of the software. You should take 1 or 2 trades based off of this. It's all worth it, right? It adds value, right? You only want to put things on your chart that adds value to your trading. So pay attention when imbalances appear, but also put them in context of market structure. Are buying imbalances coming in, as we just made a low, swing high, or a swing low, or the low of the day? Are selling imbalances coming in at the high of the day? Are they coming in just off the high of the day? As the market starts turning to go lower, are the aggressive sellers coming in? Those are questions you always want to be asking yourselves. Put them in context, not just, oh, there's a bunch of buying imbalances here. I got to get long. It's better when you put it in context to the market. Trade everything in context. So the third part I want to talk about is how to profit from understanding how orders move market prices. And that's really what you want to do, right? Markets present opportunities every day for traders who know what to look for. That's the key, knowing what to look for, because you could stare at a chart and try and figure it out by yourself. You might be able to do it, most likely not. You're going to struggle. That's why I like doing these trainings, is because I like to sort of, get people's thinking, on what to look for. And I'm going to talk about three things to look for. And these are terms that I've coined myself. One is delta flips, two is stopping volume, three is delta pressure. Excuse me. And delta flips. Okay. So remember, delta is a way to measure the aggressive trading taking place in a market, right? And basically what delta flips looks for is, where delta was strong, but then ended up weak, or delta was very weak and ended up strong, right? In the bar itself. I'm not talking about over a half hour, or anything like that. I'm talking about right now, right? Because these offer tremendous trading opportunities. And this is soybeans, right? People, soybeans, I'm going to trade soybeans. Actually, soybeans is a fantastic market to trade. A lot of commodity markets follow order flow great, right? Because you don't have a lot of hot money that you have in, um, a lot of the equities. There's a lot of other type of trading that's going on, whereas commodities tend to follow order flow better because they're really following the supply and demand paradigm a lot closer, because people are buying it to use, right? People are going to make stuff with commodities, whether it's, making, um, you know, like for wheat, for example, right? They're going to make bread, things like that, oil, they're going to make gasoline, and they're going to refine it, things like that. People need to use it. And, this market has been selling off, but there's something happening in the order flow right in here that's very bearish. And honestly, a lot of people will miss it. And they're going to miss this move, the sharp move down. Forget about the rest of the move here, but just this move from, 76 down to 70, or even 75 down to 70, that's a $500 move very fast. All right? Again, a lot of traders, nowadays, there's nothing sexy, there's nothing glamorous about trading soybeans. But soybeans, up until about 1998, probably made more millionaires out of all the commodity markets than any other one, honestly. Um, so when you're looking at the delta, right, what happened? Okay, well, a couple things. So here, right, you have this bar, and again, I'm going to talk about this in the next a little bit later, but because there's a lot of bearish information happening in this bar. This bar's got a positive delta of 179, and it closed at minus 20, the delta. Okay, so it went from plus 179 to minus 20. What's that telling you? Well, you had very strong aggressive buying early in the bar, but the aggressive selling came in, reversed all of that, and it closed down. It closed negative delta, minus 20. That's what we call a delta flip, where it's strong in one direction early, then reverses and closes in the opposite direction. Now, strong is a relative term. 179 is this max delta. You don't see any other bars anywhere near it. I mean, this bar here had positive delta of 155, so the 179 is still stronger than the final delta. This one had a max delta of 225. But I know that 179 in soybeans on a 1 minute chart is heavy, right? It's a strong number. So to see that reverse is telling me, yeah, you know what? Something's changed in market sentiment right now. I don't need to wait till the market breaks down to start recognizing. I can see that as this bar is being formed and is completing. So I could be ready in the next bar to be getting short around 76 and a half. And then you get the bar from 77 right down to 73. Right? Then the next bar goes lower. That's what's called a delta flip. Here's another example. This is E-minis yesterday. Market shoots up, boom, you got this nice, shooting star type pattern. But look at the delta, positive 1025. Delta closed at minus 36. So not only did it go up 1,000 delta, but sold off another 1,000 and just closed at minus 96. That's very bearish, right? You can see the market selling continued because it's very, everyone's FOMOing in. Everyone, oh, we're going, the numbers not so bad, inflation, who cares? Everyone's buying. But then, who knows? Maybe some big aggressive sellers came in and said, not on my watch, and start pushing the market back down. And the market dropped from, 70 down to 60 over the next 1, 2, 3, 4, 5 minutes. These are 1 minute, so 1 minute charts. So basically 5 minutes, dropped 10 points. It's another example, high of the day, right here. Okay, now there's other information in the order flows, there's divergence, there's a bearish ratio. But really, if you're just looking at the delta, you can see positive 708. It's your highest max delta out of any of these previous bars. You're at your high of the day. Obviously, you want to see nice positive delta. Okay, max delta, yeah, that's nice. But the final delta ended up at just negative 128. So it went from positive 700 and closed at just minus 100. So it's actually a shift from plus, it's an 800 value difference in the delta to the downside. And again, all you got to do is, okay, well, this moves over. Stick a fork in it for now. I mean, later in the day, it may go back up, but who knows? But for now, the trade is to the downside. And you can see it dropped from 77 right down to 67 very methodically, lower. Every bar's got like a lower low, lower high. That's what you want to see. That's why I talk about sometimes these things in the order flow. It's just it's so obvious to see. Now, this was a very strong one here. This was in the E-minis on the 13th. Again, very strong, nice positive delta up 233. It closed at minus 387. So it went from very strong positive to a very strong negative. Well, what do you think that's telling you? Well, not only was, I was showing you examples earlier where it just sort of closed around neutral, around zero. Now it's gone very negative, quite strong. So it went from a very nice, healthy, positive 233 to a minus 387. That's a change of 500, almost 600 contracts in the delta from positive to negative, right? And you get the market little sell off there. Again, this one, right? These things, right? People talk about the market being fractal, right? You got this sort of the star, you got the nice positive delta 948. It closed only at minus 139. So, it's a shift in 800 delta from plus 948 to only plus 139. Then obviously the next bar, if you're not convinced of this bar here, the next bar, big negative delta, minus 662. But, this bar, very similar to this bar, right? So, these markets, what you're seeing a lot of times, it's repeats itself, right? Now, it's not going to be exactly the same, but it's close enough that you can make good trading decisions. So the next thing I want to talk about is stopping volume, right? Volume matters. I don't care what anybody says. Volume does matter. Size matters. Extra heavy volume matters even more, just like eggs, right? You got eggs coming all different shapes and sizes, right? So you cook an omelet, right? For yourself, you're going to use this egg. You use the quail egg, you're going to be hungry, right? It's not going to be enough. You use the ostrich egg or the emu egg, yeah, you could feed the whole family. So volume matters, size matters. Size is volume. Stopping volume, right, is what I'm talking about. And what stopping volume is, it's heavy volume coming in at price. This is the soybean chart that I showed you earlier with sort of the shift in the delta taking place. But what do we see here on the footprint? If I just drew this line here because I know that I've got stopping volume here. When I have stopping volume, really what that's going to do is it's going to stop the market from going higher or lower. In this case, it's stopping the market from going higher. Market doesn't come back to the 78 level. Why? Because I can see the volume in here at 187 on the offer. So I know that there's sellers in there. If I know there's sellers in there, I'm not going to fight it. I'm going to go in the direction that they're selling in, or or the direction they're buying in. This is 10 years. This is a 5-minute chart. Okay. You can see the market sort of comes back up here. We got 1, 2, 3 point of controls all sort of lined up. You do have this, what is that? It's like 18 lots poked up above. Then it came in, and then somebody basically put their foot down on the market, said, no, you're not going to go any higher than this. And you can see they're offering it, 1,800 traded on the offer. Even here, 5,000 traded here on the offer. Half the volume of this bar. This bar's got 10,000 contracts, 10,870, 5,400, 5,041 contracts trade on the offer side. So over half the volume of this bar traded on the offer up here. Basically, somebody say, no, I'm not going to let you go higher. This is 10 years on a 4-range chart. And again, it looks, it's a market that's going sideways. But again, you're seeing the heavy volume taking place just outside of this little range. It's telling me there's offers up in here, right? That this market isn't going to go any higher. This is gold, right? Volume is relative, right? If you're looking at gold, you're not going to get the same volumes that you're going to see on 10 years. You're definitely not going to get the same volumes you see on E-minis. It's relative. But I know that by watching the points of control in a bar and where they appear, if they're stopping volume, right? I can see right up in here, stopping volume. Point of control is up here at the top of the bar. Market reverses, starts selling off. It's clear as day. It's like a sore thumb sticking out there. Stopping volume right down here. Again, this is Euro currency right in here. I could see. Now, this is something that's unique to my software, is what we call prominent point of controls, right? Which is this. I don't have it on there, but I put it on this one. So you can see it's blue. It's telling me it's bullish stopping volume. So if I have a point of control, right? Every bar has a point of control, the price level in the bar with the most volume. But if I see a blue point of control, it's telling me, they're stopping volume to stop this move down. Just as a red one here, well, it's magenta actually, is telling me they're stopping volume to the upside, right in here. You can see the market came off. So all I got to do is I just got to look for these blues or magenta point of controls when they come in. Here's another one right up here at the high of the day. Stopping volume at the high of the day, to me, is one of the easiest trades to take. Okay, I know the market just hit the high of the day. Now I got stopping volume. What am I going to do? Trade it to the short side, because I can't get long, because I know there's offers up there. I know there's sellers up there, right? So you got to be trading it to the short side. RTY, Russell, a very illiquid market at times, but still you're going to see stopping volume appear in these markets, right? Market is, doing what it's doing. Not a lot of volume. I mean, you can see in here a lot of zeros appearing in these bars. Then it just sort of stops in here and almost instantly reverses. So, that's the simple, easiest thing. Let the software do that for you. Let the software highlight to you. I've talked about multiple imbalances, right? Software can highlight that to you. Stopping volume, market can highlight it to you. Now, delta flips is something, it's a little bit more advanced that you got to look for yourself. And this next one I'm going to talk about, delta pressure, is something you also got to learn to look for yourself. It's basically what it is. It's supportive buying or resistance selling. So basically, when big traders step in to take the other side of aggressive buying or the aggressive selling and create essentially support or resistance in a moving market. And the way I like to describe it, it's like the tugboats, right? You got the big freighter, the seagoing freighter, and generally, it's moving in a direction, and you got these little tugboats just to give it a little bit of a nudge, keep it going in that direction. So with delta pressure, it's a market that's already going, say, down, and what you have is you got more selling coming in, sort of adding overhead resistance to it, just as if a market is rallying, right? You're seeing supportive buying coming in to keep that move going up. Because if you don't have supportive buying coming in on a move going up, it's not going to keep going up, because once those aggressive sellers come in, they're just going to drive it down. But if you have supportive buying holding up that market, even though you got aggressive selling coming in, they're absorbing that selling pressure. Just as, if a market is going down, when markets go down, people like to buy the dip, right? But if there's still some nice passive selling, people with supply coming in there to sort of just give the market, a little bit of resistance to absorb whatever aggressive buying is coming in, it's going to help keep that market going down. And this is, this is slightly a little bit more advanced concept for traders to understand, but once you know what to look for, it becomes clear as day. Okay, so here, right, we got this market selling off, negative deltas, right? Then the market starts rallying, positive deltas. But look, you got green bar, and you got negative delta. Everyone's, oh, Mike, you told me earlier markets go up on aggressive buying, they go down on aggressive selling. They go up on positive delta, they go down on negative delta. Well, yeah, generally. But delta is a little bit multi-dimensional, because it's, again, what does it measure? It measures the difference of aggressive buying and aggressive selling in a bar. So if I got a market that's going up on negative delta, it's telling me I got supportive buying coming in here. Because it's telling me that every time the aggressive selling is coming in, there's passive buyers coming in to absorb that. Now you still got the aggressive buying coming in, but that aggressive selling is just being scooped up by the strong passive buying that's taking place. That's why you got the negative deltas in these two bars, is because you got strong buyers bidding this market. They're offering support to this market. They're absorbing all that selling until finally the sellers shot all their bullets. They got nothing left. And then all that's left is the aggressive buying, and then the market shoots up very quickly, very fast. Here's the market that's selling off, right? You're selling off on positive delta. Mike, what is this? Orderflow is a scam. No, it's not. You got to understand what you're looking at and start to put the pieces together. We got positive delta on red bar, red bar, red bar. But why is it going down? Well, every time the aggressive buyers step in, you have passive sellers offering out their supply to keep, because the people that have the supply generally got the deeper pockets, generally have a better idea of what's happening in the market. They're more longer term traders. They're there to absorb whatever buying, because they think this market's still going lower. So they're happy to sell it at 40.16. They're happy to sell it at 40.15. They're happy to sell it at 40.14. They don't have to come in and hit all the bids, even though they think the market's going down, because they know that at low prices generally you're going to get potentially some people that are trying to buy. But if they got a lot of supply and they think the market's going down, they're happy to sell it here at 16. They're happy to sell it at 15. They're happy to sell it at 14, 13, 12 as the market is dropping. They don't have, because they know that if they come in and start hitting all the bids because they want to be short or they want to be out of a position, the market's going to drop further, and it's going to drop further faster. And they're just going to shoot themselves in the foot. They're going to have bad execution on the trade, and they're going to lose more money because they could have sold it at a better price. Again, same thing here in the gold, right? Going down on positive delta. Look at this market drop from 17.18 down to 17, 10, all on positive delta. Why? Because there's supply. People are distributing their supply. With Wyckoff and all that, people talk about, the different phases, accumulation, distribution. They always talk about distribution at higher prices, not necessarily at these at lows of the day. But what you're seeing in the order flow, you're seeing heavy volume. There's 100 contracts being traded on the offer, right? You're seeing, 70, 80, you're seeing 105, 124. All the volumes on the offer side is much greater than the bid side. So that's what delta pressure is, right? It's this supply coming into the market to keep the pressure on the market, keep it going down, or if the market is going up, to support the market, right? To absorb whatever selling is coming in, so the market can go higher. And this morning, great example, right? We had that number earlier today, and this is 10 years It's on a 1 minute chart, and you can just you start to get a sense of what to expect from the market based off of what is happening in the delta. Okay, so market obviously shot up, then it starts ticking down, right? Down, down, down on negative, on positive delta, right? Why isn't it going down like here on negative delta? It's going down on positive delta, positive 425, positive 1100. Why? I got heavy volume up here. There's people in here. Shit, market just shot up. I can sell it. I'm happy to offer it out up here at 20. What is that? 25 and a half, and again here at 24, right? Because they think the market should be trading 20, 1575 here, 2300, 1100. What's the volumes down here? They're 27. I mean, look at this. 1500, then you got 500, 500, 300, 700. You got the supply coming in to stop those moves, and oftentimes you're going to see it happen with stopping volume. You can start putting these things together and start to make sense. I mean, you don't have to take every single thing I'm talking about. Just look for one or two things in the order flow. That's how you become a better trader. You start with something that makes sense to you, something that resonates with you. You say, you know what, I understand why that happens in the market. Then you go from there, you build on it. Right? There's that saying, how do you eat an elephant? Well, you eat it one bite at a time. Same thing with trading. There's a lot of different aspects of the market that go into trading. Take the pieces that make sense to you and build off of it. Again, this is this morning, right? Market, what's the market doing? Well, we're going up, right? Positive deltas. You got red bars here with positive delta. Well, it's telling you there's supportive buying. Okay. And you just look for these things right here, right in here, right at this low, right? Green bar up. But you got strong negative delta. It's your strongest negative delta up to this point on this chart, at least. It's minus 1400. What's a green bar up? What the heck is going on? You even got a selling imbalance in here. Yeah. Why do I got the big strong negative delta? It's because I got strong buyers, strong passive buyers. They're willing to absorb whatever selling is going on in this market to help keep the market, give it support so this market can go higher, which it does. Okay, so I mean, you start to put these things together, start to understand them more, right? But build off of what, reading the delta, reading imbalances. I didn't spend much time on point of controls, but point of controls are also important. So hopefully, over the last 45 minutes, 50 minutes or so, I've covered a lot of ground, and hopefully you'll think it's time well spent. I think so, right? Hopefully you've learned a lot about why and how the markets move. Now remember, this ain't brain surgery, okay? It's trading. Sometimes people want to make it more complicated than it needs to be. Stick to things that make sense to you, right? We don't realize it, but every day we're always trading. We go to a store, and if something is too expensive in one store, I'm not going to get that bag of chips here because I know I can go to this other store and it's 50 cents cheaper. Right? You'll do that. You're making a trade in a sense. Now, I can't cover everything in a quick training. I wish I could, but there's really a lot about order flow, right? Because it's so fascinating. There's a lot of little nuances, but I hope you have a good understanding of the order flow basics, things to look for in the order flow. And if you're interested in learning more, I got a very special deal for you, right? You're going to be excited. It's the Orderflows Trader 5.0. And actually, well, I'm really excited because in a couple of weeks, I'm going to be releasing the new version of Orderflows Trader. It's going to be Orderflows Trader 6.0. And there's some new features, but more importantly, for those of you that like to automate things and run strategy analysis, you haven't been able to do that on a footprint chart before. With the Orderflows Trader 6, you're going to be able to do that. So you're going to be able to take certain aspects of the order flow, like stopping volume, market exhaustion, things like that, price rejection. You can be able to analyze that with other forms of technical analysis. And it's going to, in my opinion, really a big leap forward. But really what the Orderflows Trader 5.0, it's like plugging a computer into a order flow trader's mind, right? What they're going to look for, what's happening in the market. So you're going to make better trading decisions. Now, having software is one thing, right? There's a lot of software out there, okay? But just having good software is no guarantee you're going to be successful in trading. You still need some education. And the problem with a lot of software out there, especially trading software, is like you buy it and there's no documentation. There's no lessons on how to really use it. They're sort of, okay, yeah, here's my software. You see a couple of videos on it, and it's just like, leave it to you to figure out how to apply it. I don't do that, right? I want to give you the good foundation, the good education, so that you can be successful, right? Sometimes I don't even look at it as, being a software vendor. I like to think of myself more as an education vendor. I want to give you that education so you can become a better trader overall. And so what I'm going to throw in with the software is my order flows trading course, which I normally sell for $297. It's a 20 lesson course. This was the first course on trading order flow out there. A lot of people have copied it. A lot of people go out there, they copy my ideas, and they try to push it off as their own. I mean, I'm happy that people find value in what I'm doing, but a lot of the concepts that you see out there, I was the first one to put them out. That's why I started putting it out, because people were stealing my concepts. And also, to sweeten the deal even further, I'm going to give you access to my Inner Circle video series, which the only way you can get it now is through getting the software. There's 56 videos on advanced order flow analysis, tips, things to look for in the order flow, etc. Well, when I used to sell it, it was about $500. But again, now it's just not available. It's only available for users of my software. So you start adding that up together. The software I normally sell for $899. The training is $297. The Inner Circle video series is $497. That's almost $1,700. But at the end of the day, I realize, right, learning from videos and books is one thing, right? It takes discipline, it takes commitment on your part. But what I found to be very helpful is a live training environment where you can come in and ask questions. I'm there every week, unless there's some major holiday or some emergency. But for over the last 3 years, I've been doing these live sessions every Tuesday night. It's open for all users of my software to come in, learn about what I saw interesting in the order flow, ask questions. Right, I like to make it interactive. Sometimes I spend the whole session just answering questions, but usually it's about half the session. When people say, hey, what do you think of this, or what do you think of that chart? Can you take a look at this? Or maybe they got a question about the software itself, right? It's there. It's a resource where I'm there every week. So sometimes people email, oh, Mike, I can never reach you. Well, I'm here every week, right? You can show up there and ask me your question. I think there's 100. I haven't updated this slide, but there's, I think, over 170 episodes now. And again, if you can't attend live, there's replays you can watch, right? And there's some people, they want to sell you software, then they want to charge you extra on how to use it. What's that about? That this is the hell out of me. It's like, what? I'm buying your software. You should provide some training, but this is more than just training on it. It's just a place where you can go and learn more about order flow. Now, what I discussed today is just a small sample of the kind of analysis I talk about in my weekly group training sessions, and what can be found in the Inner Circle video series. But I go into much more detail in the live sessions, right? And again, you're able to ask questions, you're able to have interaction with me. So, I really highly recommend you guys get started now with order flow, because at the end of the day, you want to become a better trader, and there's no better way to become a better trader than by using order flow. So what you want to do is you want to go to orderflows.com/oft5 and scroll down to the bottom of the page. This is what the page looks like. You just scroll down and it's going to take you to this button here. You're going to see what you're going to get. You're going to get the order flow software, the trading courses, the live access to the live group training. You just click on this button, buy now, right? Takes you to PayPal. PayPal processes your payment. And, within a few hours, you'll get all your details, right? You're going to get your access to the software, your license, access to the training courses, etc. Again, realize it does go, you're paying through PayPal, so you got to check your PayPal, the email address that you use to log into PayPal. Sometimes people forget about it because they use a different PayPal address, but just check that one. And it's just the special offer is just a one-time payment of $749. right? It's no monthly recurring charges. I'm not one of these companies out there that's going to keep charging you every month, and then it's like you're going to forget about it. And I don't charge you every year. It's just a one-time payment. All future updates are free. So when we release the new version of Orderflows Trader 6 by next month, you're going to get that upgrade for free. And I'll be honest with you, there's a lot of changes in this new Orderflows Trader 6 that actually the price of the software is going to be increasing as well. So, now is the time to come in and lock it in at this lower price because you're going to get the upgrade for free. So go to orderflows.com/off5. I put the link in the chat. But as an extra bonus for you guys today for Investors Expo, you're going to get access to the Orderflows Playbook, which is a short training course on sort of advanced order flow techniques and analysis. And there's about 10, I think, or 11 additional trade setups in there that you can learn them to apply to your trading. So again, you want to get started now, go to orderflows.com/oft5.html. And what you're going to get is you're going to get the Orderflows Trader 5.0 and the 6.0 when we release it, which is normally $8.99. You're going to get the Orderflow Trading Course, which is normally $2.97. The access to the Inner Circle video series, which is normally $4.97. Access to the weekly group training. Again, I can't, I don't want to put a price on that because it's kind of priceless. You can learn a lot in a very short period of time. But some people charge something very similar to that. They charge about $200 a month. You're going to get the Orderflows Playbook as well, which is also $2.97. But you can get all of that for just a one-time payment of $7.49. So go to orderflows.com/oft5, or you can just go to orderflows.com. You could, that's my main website. But this is the special offer. I mean, if you go to just orderflows.com, you go around, you might end up paying more than this special offer. Now, I did write a book on trading. That's how I started my software company, actually, is I started writing a book after I left JP Morgan called Trading Order Flow. It's a 150-page book, and you're not going to get the actual hardcover copy. You'll get a digital download. So just go to orderflows.com/book.html. You'll have to enter your name and email address, hit submit, and then it will take you to that page. But again, it's orderflows.com/book.html. It's just not orderflows.com/book. You got to add the HTML on the end. And that's it. So just go to orderflows.com/oft5.html and it'll get started. I mean, there's really, the price that we charge for our software and education is, it's a little bit, it's not a lot. People like, oh, Michael, trading software is so expensive, I can't afford it. Well, if you can't afford $7.49 for trading software, how are you going to trade? Right? Because it takes money to trade. And I just tell people, just save your money, right? If this offer is something that interests you, but you can't afford it right now, just come back in a few months. Email me, say, Mike, I watched your presentation. Can you still offer that price? Yeah, I will. I'll still honor it, right? But I want to make sure you're in a good spot financially before you start trading. And remember, right, in the end, we only regret the chances we didn't take. I know a lot of people, right, when COVID hit, we got shut down on everything. Everyone wanted to start to trading. And, some people got started. And now that's all they do is trade, right? They don't need to work anymore. They're trading. And then there's people like, yeah, I'm going to start this thing. And then they never started it. And now it's, 2022 going on 2023, and they still haven't started trading. So, at the end of the day, you got to take that step forward, right? And the first step is getting a good base in trading, a good foundation in order flow. So anyway, guys, I'm just looking in there. There's no questions, so I'll end it there for today. So have a great rest of the day and have a great rest of the week. And again, thanks everyone for taking the time out today. And I hope you appreciated it. I know I had a lot of fun. So thanks everybody, and I'll catch you guys later. Bye-bye.